Yeah, it's just me.
Okay.
Anybody jump in on the other one, Yvette?
No, I'm saying it's just me.
Oh, okay.
The camera on this computer is weird looking. It has a weird delay.
Okay, I finally got in so I can take attendance. That's my whole purpose. I'm in charge of attendance.
Can you guys see my screen again?
Yep.
Yeah.
Okay. All right. Just want to make sure everyone can hear. Ashley and Mindy, can you guys hear me? If you can
Yes.
respond.
Sorry, do y'all mind if I turn my camera off? Because I literally just got off and I'm trying to.
No,
No.
that's fine. We're actually gonna ask you to mute and probably turn your camera off anyway.
Okay.
Yeah. So welcome everybody and to Home Buying with Prosperity Connection and People's National Bank. We do these classes for home buying maybe 3 times a month with Prosperity Connection. I'm excited because this year we're back to our Tuesday and Thursday classes. Check out our website, www.prosperityconnection.org for all of our classes. I can't remember what the subject for this month is. I want to say it's budgeting. So we'll have another budgeting class either the third Thursday of this month. That's something new that we're doing this year. We've decided the third or fourth Thursday of the month, we're always going to have a budgeting class. So if you need a budgeting class, we will have a budgeting class. And then also I want you to check out our counterpart, St. Louis Builds Credit. They do our credit classes and they normally do those on Wednesdays. And I think they do those at 11 on some Wednesdays and 6 on other Wednesdays, but check out our website. So I'm going to turn it over to Mr. Kris. And if you have any questions, please write them in the chat. I will be keeping track of the chat. All right. And thank you.
Good evening, everybody. My name is Kris Mills. I am with People's National Bank. We partner with Prosperity Connection and other nonprofits in the area to help people achieve home ownership. Basically, what my whole job description is to help people get financed that are typically considered not financeable through traditional mortgage types. I do all lending, but we also specialize with a program that's not actually on credit score, which I'll get into. Tonight, what I'll be sharing is basically a 30,000 overfoot view of mortgage lending, credit, and Yvette alluded to one big thing, which is budgeting. I don't care who you are, you need a written budget that you know the ins and outs of it daily because when life happens, you need to know how to rearrange your money. So I will be probably saying budgeting, budgeting, budgeting throughout this whole thing because you can't improve your credit if you don't have a right budget. You can't start saving if you don't have the right. You just can't do anything if you don't have the right budget. So things we'll talk about is number one, why should you own a home versus renting? And then it'll be the actual cost of renting. There is an actual cost to you for renting. Financing the home, and in regards to financing the home, your loan options, the traditional FHA, conventional VA, USDA, and then we call it our Buildings Community Together loan, and PNB stands for People's National Bank. So if you guys, like she said, you got any questions, you can unmute yourself and you can put it in the chat. I really don't care. I'd rather you be able to express your question pretty quickly. So the first thing, why own a home? Is this thing called appreciation, basically meaning that your home value will increase potentially each year that you own it. It's only been very few instances in historic times where property values just tank. So this is kind of a historic chart over a period from 91 to 2015, where you can see how home increased from 91 to 2005, and 2005 to 2010, the market crashed, and actually it's on its way back now, back in such a way you're seeing multiple offers on the same house. So if one house is being sold for $100,000, you have 3 to 5, 6 different contracts from different people try to buy that one home. So this appreciation is how you build generational wealth. You build this wealth slowly over time. When you have a home appreciation, you have what's called equity. And to give you an example, if you purchased a home in 2010 for $100,000, it round about now to be anywhere, depending on where it is, 114 to 120,000. So that means as you paying your mortgage balance down, your home value is going up, and that difference in between is called equity, which is basically your money. You can take it out in the form of refinance, or when you sell the home, you take that as a profit. So, as I mentioned before, appreciation is when your home increases in value, equity, and then your net worth, all into that. Basically, your net worth, real simple, is how much you owe versus how much you actually have as an asset, meaning 401k, savings, equity in your home, all those type of things. With the increase of your equity, you improve your net worth, which in most cases, people have a negative net worth, flat net worth, or it's anywhere above that. Home ownership is a slow path or a systematic path, actually, to be able to get yourself into a better place, along, not to mention with your children, because that's how most generational wealth is passed, is through home ownership and then insurance. So most people are renting right now, and then with COVID, I know there's been a couple things where the rents have frozen, but before COVID, I know rents actually started to actually increase. Um, this is just an average rent of basically a 2 bedroom around the St. Louis area is anywhere about 870. I've seen all the way up to about $1,000 per month. So what we're equivalent it to, that's money that you're spending each and every month that you has no benefit. Go ahead. You had a question? Was there a question?
I don't have one.
Oh, okay. So assuming this 868 a month, around $900 a month, if you paid this each and every month, that is an expense that you have going out that you have no benefit for. Paying that rent builds you no equity into the property or apartment that you're living. So in about a 5 years time, the real cost of you renting without no benefit is a little over $50,000. If you rent it over 10 years, you've given away basically $100,000, because the rent that you pay is help paying down the equity in the property that you're living in, or if it's free and clear, you're just putting the money directly into the landlord's pocket. So assuming that same about 870 a month, if your interest rate was even at 4.5% and it appreciated, that's about $2,300 a month applied toward your principal balance, and the equity that you build is actually a little bit more than 30,000. So in renting, it actually costs you 52,000 versus buying the worst case scenario, you've made $30,000. That is a $82,000 difference swing one way or another. You paying out money or you getting money back. That is the real cost of renting, because when you rent, you have no ownership stake in it whatsoever, and that money is just gone. And you're never getting it back. So, financing a home. It's a lot that goes into it, but I'm gonna kind of break it down in little small chunks. Um, you have your interest rate, you have tax benefit, and then the big last point is the qualification criteria. What do you need to actually get approved for a loan to go shop to buy a house? So interest rates are still at an all-time low. Basically means because rates are down here towards the 3.5 range, you could buy a house that is actually more that you could afford if the rate was at 6% because the payment would be higher. So in today's terms, you would be able to probably buy a $150,000 house at the 3.5, where in the same market, if the rate was 5.5, that would probably decrease a good 20 to 30,000. So the interest rate does play a crucial role into how much you can afford because there's three factors that we look at into a payment: the principal and interest, which is the money that you're paying back for the money that you borrowed. Then you have your real estate taxes and you have your homeowner insurance. And in many cases, you have mortgage insurance. All those three things coupled with the insurance allows you to know how much you can actually purchase. So with the interest that you pay on the home and the improvements that you have on the home, you have a tax deduction that comes along with that. So there's a portion of your rent that you pay. They send you a statement at the end of the year showing how much interest you paid on the loan. You give that to your tax provider, and that tax provider calculates and lets you know how much of a tax benefit that you get, along with your property tax and any home improvements that you may have done. Or in some cases, if you give them the closing disclosure, some of the fees for the loan and all that can be give you a tax benefit as well. When you're renting, unless you are of retirement age, you usually don't have any kind of benefit at all from renting at all, and that's if you retired under a certain income bracket, from my understanding of that. The biggest piece, the qualification criteria. So when you apply for a mortgage or any type of loan, whether it be credit card, car loan, anything else like that, the first step any lender is going to ask you for is your personal information. So you're going to be providing your name, your date of birth, social security number, ITIN number if you don't have a social security number, your valid ID, employment information, and 2 years worth of residency. The first thing we want to establish is you are who you say you are applying for this loan. And then based off that, the next thing that they take a look at is, let's see credit history. Who have you paid in the past? Who has lent you credit in the past? And how have you paid them? So when it comes to looking at your credit, we're looking for your debts. How many late payments have you had in the last 12 months? Is it because, especially now, before COVID hit, we would look to see if it was an isolated incident. If you had a late payment in April, then had another one in July, then had another one in September, what went on? What we've seen lately is uh, late payments started in March, didn't pick back up into September because people were furloughed. All those things. What we're trying to do in a snapshot with the credit report and the debts to see what debts do you have, how have you paid them, and if there's been any missteps, the reason why. Do you have any collections? Do you have any charge-off, judgments, tax liens, or bankruptcies? The big two things we look at first is collections. So let's say you had a credit card for $1,000. You got more than 4 months behind late. Oh, yes. Oh, I'm sorry. I thought somebody was saying. Let's say you had a credit card and you got behind on the payments 4 months consecutively in a row. They would, before that time, start calling you, and your account would be making collections, meaning they're actively trying to get the money that is past owed, plus the new, make sure that you have the funds coming up for the next payment. Once the collections action is unsuccessful, depending on the time frame, it will then go to a charge off, which basically means the company said, we tried to collect, we don't believe we're ever getting our money off, we're writing it as a bad loss on our books. Now, what possibly could happen in between the collections and the charge offs is a judgment may occur, meaning that you owe enough that they deem it worthy enough to take you to court and have a judge mandate that you actually pay them back. So if you ever get anything in the mail served with paper saying you got to go to court to pay something, always show up, because if you do not show up, 100% of the time you're going to get a judgment, which is a lien placed on you, and then any property that you try to purchase in the future. So you want to head it off before it actually gets to a judgment. and then tax liens for back taxes, either for personal or business, and then bankruptcy, Chapter 7 or Chapter 13. So that's what we're looking for when we pull your credit and look at the debts. Other things we look at is car loans, student loans, tax liens. If they show up, they always don't show up on the credit report, but there is a section on the loan application. We ask you if you owe any federal debt or back taxes. If you pay child support, that's also considered a debt, and other debt that you may have. So when you apply, one of the things we'll ask you for is bank statements. If we can see a recurring debt coming out of your bank account each month, that actually may get added as a debt. And then recently acquired debt, anything that shows up as an inquiry on your credit report, but actually doesn't actually report. So if we pulled your credit report today and you had an inquiry in December, and you bought a new car in December, that new car payment actually wouldn't show up in January. So you would have to tell us when we ask, because we'll ask you right up front, hey, look, did this inquiry result in you getting a new type of loan? If so, what are the terms? How much did you borrow? What's the interest rate? What's the payment? So we can get all that added into the debt to income ratio. So that is a very big thing. The next thing we look at is your income. How stable is it? Are you W-2? Are you self-employed? Are you retired? Is it a mix of all that? We get all viable sources of income. Some banks, like our bank, also will take a Section 8 voucher and use that to get you qualified as well. There's only one other bank in St. Louis that does that, and I used to work for them too. So I helped get it set up there. So, but when it comes to salary, the only big thing is during COVID, there is a what they call a COVID-19 attestation saying that if your income has been affected, how so? And then do you think in the next 90 days is going to get affected where you think you're going to be furloughed on your job? So that is something that is new, that is going on right now. It's real particular depending on what line of work that you're in. Self-employed people, it's also a little bit more difficult now because you have to show if COVID affected your business. If it has affected your business, how are you going to be viable for the next 90 days if another round or more shutoffs or anything else like that happens? If you're retirement age, we take a look at annuity, Social Security, anything that you're getting on a monthly basis. Child support, we technically count it as long as it's going to continue for more than 3 years. But this one, child support is an expiring income, meaning if we set you up saying that you can afford a house payment of $850, and that's dependent on you getting $200 to $300 in child support, and in 3 years that $200 to $300 goes away, that is a scary proposition. How are you going to actually make up that extra $200 to $300? I say this, the statistics bear out that most people, 80% or so, file bankruptcy because they have a deficit of $300 or $50 or more per month in their budget. So if you're going into purchasing a home, knowing that you have an income that's about to drop off, and it's about $200 to $300, that's a scary proposition. It can be done, but just know you have to know that and have a plan for it. That's why I say the budgeting is crucial. The budgeting is crucial when it goes back to the debts. If you know you're going to have to buy a car because your car is breaking down, if you know if you're going to have to move and you're going to put your kids into a different school district, gas, traveling from work, private school, all those type of things, we'll go into it. So once we get this, we will kind of do an assessment of your debts, what you owe versus your income to see what the affordable mortgage payment that you can have. When it gets to that point, there's aspects to the home purchase process that you're going to have money for. The first part is down payment. So when you get approved and you get a letter to go shop, you're going to have funds for the down payment. and I'll get this into the later. So usually it's anywhere from 3 to 5% down of whatever the purchase price. If you don't have that, there are down payment assistance programs available to you, and we can go through all those. Most of them are forgivable grants, which means it's free money as long as you stay in the property. One's a minimum of 5 years. The other one is forgivable after 10 years, and in year 5, it starts decreasing down. And then some down payment assistance you actually have to pay back. The down payment assistance, it is determined by your household size and your household income. There's usually down payment assistance even for non-first-time home buyers and people that make over 6 figures in certain cases. So that would be the first key. The earnest money, that would be something that you would definitely have to have liquid. So when you go and search for a property and you want to write a contract, say, hey, Mr. Seller, I want to buy your home. First thing they're going to ask you for, besides the approval letter saying that you have funds back from a bank that you can actually purchase the property, is then if they accept it, they're going to ask you for either $500 or to $1,000, and that's what the earnest money is. That earnest money does get applied to the down payment, but that is money that you're going to have liquid in your account. So even if I'm able to get you all the down payment and closing cost assistance, you're still going to need about $1,000 to $1,500 up to $2,000 of all your own money for the earnest money and inspection fees. For the building inspector to go to see the home, to the basement, to give you a report and tell you everything that's wrong with the property, so you can go back to the seller, say, hey, these things are wrong with the property. You need, would you please fix these or give me a discount or more closing cost credit to offset what's going to cost to repair these things. Usually, if you get to the point where you're qualified and you're out searching for a home, if the deal's going to fall apart, it's usually going to fall apart at the inspection time. Something's going to come back on that inspection that's going to give you pause. And if the seller can't, won't, or you guys can't come to an agreement, you can do what's called a mutual release, and you get your earnest money back and you go your separate way. Be mindful though, the next contract that you write, you'll have to put another earnest money down and also have to pay for more inspection fees. The other things that you'll need to have funds for is closing costs and escrows go hand in hand. So when you go to the closing, there's closing costs, which is the lender fee, third-party title fees, credit report fee, and all the other third-party fees. Escrows is for your homeowner's insurance to protect the home if it was fire, earthquake, and then your real estate taxes. You have to have an account to set up the escrows, plus you also have to have the closing costs. So if you're taking notes, the traditional amount that you need to have covered for the closing cost is another 4.5%. So if you were purchasing a home, let's say of $100,000, and your down payment, let's just say, is 3%, that's $3,000 that you need to have allocated for the down payment, and then another $4,500 for the closing costs and prepaid. So you need a total of about $7,500 to purchase a $100,000 home. In many cases, I'm able to get you the down payment assistance. In some cases, I can get you down payment assistance and closing cost assistance to where the seller doesn't have to contribute anything towards the closing costs. They do have the option on some loans to go all the way up to 6% and contribute towards your closing costs. So if it's an FHA loan, the seller could get you up to 6% in closing costs. If it's conventional, it's 3,000, and this is a little bit ahead of the slide, but I'm trying to tie it all what your actual costs are. And then reserves are a certain type of loan, say that, okay, after you have the down payment covered, after you have the escrows and closing costs covered, you have to have at least 2, 3, 4, 5, 6 months of the mortgage payment set aside just in case. So we need to see that you have that set aside. And your lender, I definitely would know that beforehand, but if you don't choose to deal with me, if you don't have that part taken care of, that can also have a deal fall apart after you get into contract.
Kris,
Yeah, go ahead.
I have a question. I have a person that wants to know how this relates to VA loans. Can you also include the VA loan part
Yeah,
too?
the VA will be there. So VA loan, just to answer your question, it's 100% financing. So you don't need down payment for VA, but you will need to have the closing costs covered. And the seller can contribute up to 6% of the closing costs, or we can use that down payment money for the closing cost portion. I hope that answered your question. And if not, just let us know. Okay, so everyone wants to kind of know about credit, and there's Credit Karma, there's Credit Wise, there's Experian, there's all these different ways to check your credit. From my experience, the best system that I've seen that is comparable to the mortgage and consumer side is Experian. There's a free service and there's a paid service. The free service, I think you get all three credit bureaus every quarter. Um, but it's pretty accurate because there's a mortgage FICO 8 and there's a consumer score 8. So when you're looking on, there's two credit score models, consumer credit and what we have for mortgage. So consumer credit is if you were to apply for a credit card, car loan, student loan, anything other than a mortgage, that is on a different algorithm used for consumer credit. So you can look on Credit Karma, Credit Wise, or Experian, and that score would be different than when a mortgage guy pulls your credit. It should be close, but sometimes there's a 5 to sometimes even 25-point swing. So credit is one of these crazy things in our country. Me as a lender, I can pull a score today and another lender pull a score today, and we still have two sets of scores on all three different credit bureaus because depending on which credit vendor that institution chooses, they have a different risk algorithm associated, which is going to compile a number different than what we do. So as mortgage lenders, we usually use the middle of the three credit scores. So if your TransUnion credit score was a 700, your Equifax was a 650, and your Experian was a 680, we'll use the 680 score. So you toss out the high, you toss out the low, and you use the middle. So basically, a real simple simplification of credit is how it breaks down. So most of it is how you pay your debts. 35% of it is payment history. Another 30% is how much is owed. So another reason question people have is why my credit score fluctuates up and down. That goes to this amount owed in this 30% pie. If you have credit card debts and let's say your high balance is $1,000 and you only owe 250, a credit score is going to be a better score than if you owe 950 on that same line. So once you go over 30% usage, your credit score takes a dip. Once you go over 50% usage, takes another dip. 75, another dip, and then 90, they consider to max out. But if you pay it back down, you'll see your credit score kind of go back up. Other things affected is how long have you had your credit history. If you're establishing your credit, it's very quite possibly to have like a 680, 700 credit score, but all your length of credit is less than a year. In that case, yes, you have the score, but you don't have actual track record of demonstrating how you can pay somebody. So it's still relatively a high risk because of the length of time. And then the type of credit. Revolving credit is like your credit card where the interest compounds monthly. And then installment is like your car loan. You have a loan for 3, 5, 7 years. You know exactly how much your payment is. You know when your last payment is, and the interest rate is fixed every month. And then the last portion is new credit, new things that you have established. Sometimes having a new credit card with a balance of 5,000 and you only owe $100 can give you a boost in credit score. So that's kind of how the simple pie chart of the credit. As I mentioned before, Equifax, Experian, and TransUnion are the major three that do the credit monitoring. What happens is creditors report to them, and then they report what the credit people put to them. So that's how that goes. All right. So the three different types of loans that you can get, they usually go in these three buckets. A conventional loan, which you probably heard it, is uh, from Fannie Mae and Freddie Mac, and then government loans such as FHA, VA, and USDA, and then specialty programs, which usually at a actual bank instead of a mortgage lender. The difference is a bank is like People's Bank, where you can go in and put in deposits, Commerce Bank, Bank of America, versus like a USA Mortgage or a couple other places around here where all you can do is get a mortgage. Specialty programs, what they call portfolio loans, are usually at banks. So during COVID, all these are pretty much blended in together right now. It used to be government loans, FHA, VA, USDA. You can get down to a credit score as low as 580, 600. During COVID, everything is at a minimum of a 640. So if you want an FHA loan, a VA loan, or a USD loan, or even just to have an option to get into a conventional loan, you have to have a minimum of a 640 score. That said, if you do a conventional loan, if you're able to get FHA versus conventional, my preference is for you to get a conventional loan for the simple fact is the mortgage insurance associated with both of them. The one with FHA, the mortgage insurance never goes away for the life of the loan. The only way you can get rid of it is either to sell your home or refinance. That is not the case with conventional. It will fall off once you reach 80% or below of the loan to value on your home. Usually, the mortgage insurance, we may be able to get a little cheaper with conventional versus FHA. Interest rates right now, since they're all so low, there's really no drastic difference between the FHA rate and the conventional rate. One won't be a 0.5% higher than the other one because of the different type of loan programs between those two. If you're eligible to get a VA loan, that's the loan that we want to get you. That is one of the best loans out there if you're a veteran. With FHA and VA, they have an option what's called a streamline, to where once you purchase and you make your first 6 payments, if rates were to drop astronomically again, you would be able to lower your interest rate, which is simple as an updated paycheck stub, bank statements, and that's pretty much it. It's a very streamlined process. USDA is for rural properties, meaning if you wanted to purchase a home that had population around 25,000 or less. USD homes are property specific in rural areas. You have to put in the address, make sure it's USDA qualified, and then you have to also meet income and household criteria as well. Specialty programs. These come into play if you're in two instances. If number one, you can't normally get qualified for a conventional FHA, VA, or USDA loan, you may have to do a portfolio loan, or sometimes the portfolio loan offers you a better loan product than FHA, conventional, or VA. Case in point, with student loans, with FHA, since everything is in mandatory forbearance right now, you have to count 1% of the outstanding student loan balance as a payment, whether it's in deferment, forbearance, or not. So that means if you have $50,000 worth of student loan debt, we have to account $500 per month for that student loan payment, even though you may not be paying it back. And that, in most cases, impacts dramatically how much you can actually afford on the home because we have to account that $500 payment. Conventional, Whatever your mortgage payment was before COVID hit, if you were in an income-based repayment plan, your payment was zero, we could use that. If it was $50, we could use that. But you have to be qualified for a conventional loan. Some specialty programs mirror what conventional are, but they don't have mortgage insurance as well, which also, if you're close to what you want to purchase and your debt to income ratio, not having mortgage insurance and being able to count an income-based repayment plan on your student loan may be a better option than one of these three. When it comes to the mortgage, the way I do it is you're qualified for a monthly payment. Reason why I say that is if you were to purchase a $125,000 house in Maryland Heights, that payment would be different than if you purchased the same amount of home in Hazelwood or in Kirkwood or in St. Charles or in St. Louis City. They're going to all be different payments. If your maximum payment was $800 a month, that payment in Kirkwood may be $850. It may be $650 in the city. It may be it'll differ because of the taxes and insurance and everywhere that you live. So it is my job once you come through the door and you say, hey, I want to try to get qualified for a home. First thing I need to assess is based on your credit, the debt, can you qualify for a conventional FHA, VA, USDA? If not, then we have the option of our loan, which is specific to our bank because it's not based on credit score. It's a 97% conventional loan with no mortgage insurance. Your taxes and insurance being part of the mortgage payment is a must. We do require you to have a building inspection because we want to make sure that you're not buying a home that's going to have a whole bunch of problems. And then there's a mandatory savings plan. The reason why that's in effect is a lot of people can get a home, but if you don't have a pattern of savings, maintaining the home is a whole different story. If a furnace goes out, you no longer have a landlord to call to come fix it. That is money that has to come out of your pocket to be able to fix. So we have what we call a reserve fund in place for you to where after a certain amount of time, you'll be able to dip into the fund if it's deemed that it's actually necessary to help pay for some of those repairs. Because what we don't want you to have to do is figure out, okay, which bill am I not going to pay to be able to get this done? Because you have to be able to repair the home. So you're actually choosing a bill to pay or repair on the house because there's no more landlord to call. And that is a very, very, very big key. So if you have children, having a home is kind of like another child. You're going to earn money somewhere out of that. Repairing something, upkeep, upgrades that you want to do, and that budget where I said when you go into this, you know how much you can pay. I'm mentioning the budget again because when it comes to income, we determine what you can afford based off your gross. No one gets paid or lives off their gross. They live off their net. That's why that budget is so important because technically I can tell you you can afford $850 based off your gross income. That's not including your groceries, gas, hair, makeup, cell phone, car insurance, everything else that you got. Maybe off your net, that's not the actual payment that you need to have. That's why that budget is so important to help determine that before you get the house instead of figuring it out after you get the house. Because once you sign that on that dotted line, it's a 30-year commitment unless you get foreclosed on. So that is why the budget is the essential thing to this whole equation. Knowing what your current debt is and possibly going forward what your new debt is. So to be qualified for this portfolio loan of ours is basically meeting the same requirements that you have to meet for to receive down payment assistance. You have to earn under a certain amount for a household size, and I think the household size of 4. I can look that up. I think it's right around 60,000. So if you're a single person with 3 kids and you make 45,000 a year, that's pretty simple. On that, you qualify. The other way is if you want to purchase in a low or moderate income census tract. That basically means that the average income where you be purchasing is about 75,000 or less for the whole household. And then for this particular loan, you must not have owned another home in the last 3 years because we want this program to be technically for first-time home buyers. So um, there are instances like, let's say you were married, you were only on title of a home, and you're getting divorced. There's one-offs and circumstances that we can get around that if it can be documented. As in anything in this process, if there is a story that you tell, there's going to need to be a document to back it up and verify it. It's called trust and verify, and I tell you, well, no matter what story is told, if there's no document to back it up, it will not mean anything, unfortunately. Okay. So I went over this before, but collections and judgments, any derogatory credit or disputed credit, we want to know about. We want to get an understanding of, okay, so why these medical collections went into collections? Why did this car get repoed? Why were you late on this Capital One credit card? Um, the other big thing is your bank accounts. There can be no overdrafts in the last 3 months or bounce checks in your last 3 months of bank statements. We want to know that you can manage your money. And whether you're getting a conventional loan, FHA loan, VA loan, if you have overdrafts in your account, you're going to have to explain those as well because it all goes back what we call the ability to repay. You need to show us uh, it, put it this way, prove you can make your payment to us before you can get your payment. And you demonstrate that by past people that you paid and how you manage your money. So any overdrawn bank accounts or return checks, those must be resolved. And then we got to wait 3 months worth of cycles of bank statements to make sure that there are no more issues. Judgments and tax liens, they must be settled. You won't be able to buy a home in most cases if you have any kind of judgments or tax liens. There are possibilities if you're in a judgment, if you've been paying on it 12 months, it may be entered into the debt to income ratio on certain type of loans, and it's a very small window to get that done, but it is possible. But in 90% of the cases, it must be settled, which means it must be paid. Reason being, once you get a home, whoever has that judgment or tax lien against you can put a lien on the property. And then if we default to a worst case scenario, if anything were to happen, there would be other people in line to get the money besides the people that actually lent you the most of the money. So for this program and basically all the down payment assistance programs, except for one, you have to show that you have at least $1,000 of your own money into the transaction, and that would be pretty easy since $500 in most cases would be for the earnest money, and then you spend another $300 to $500 worth of inspection. So that goes back to that 1,000 to 2,000 I said you need to have of your own money earlier. So basically the next steps from here, if you guys got any questions, is if you were to want to move forward to see what you can actually afford, you would complete an application. I would do a soft credit pull at first, which is I pull your credit and it doesn't show up on a credit hit to determine where you're at. Credit score wise, number one. That's the first hurdle. If you meet the first hurdle and you can get over the 640 credit score, then we can see what options you have for the FHA, VA, USDA, or possibly conventional. If not, then it works hand in hand with Prosperity Connection, them doing the budgeting, helping you pay things off, getting your credit score up, and then moving from there. But I can't stress this enough. If you're interested in purchasing a home, the very first step you should do, besides getting your credit analyzed, is have a budget, because you kind of need both of them to be able to determine, okay, with my budget, how can I attack my credit, or is my credit because of my budget? We need both of those to kind of do a good diagnosis of your situation and be able to put a game plan for you together. Me personally, if you work with me, I actually give you a game plan in writing. If you're going to do the portfolio loan, it's usually about a 3 to 4 page document telling you exactly what you got to do to be able to get qualified and go search for a house. Most of the down payment assistance that you'll have to take a first-time homebuyer education class, which is different than this one. It's usually got to be with a HUD certified counseling agency, Beyond Housing, Better Family Life, Housing Partnership. They have one online with frameworks. There's all different kind of programs. You can do it online and go through those. So the majority, if not all, of the down payment assistance, you're going to have to take a home buyer education class along with the budgeting class to be able to get the grant money. And once you have proof of all that, you get it to us along with all your other documents, and you're out shopping for a home. And that is pretty much the 30,000 foot, very quick view of the home buying process.
We have a question.
Yeah, go ahead.
With the VA approval loan, will there be 2 inspections for one for the VA, one for the lender, and one for the VA? And I think the answer is yes.
So the VA doesn't actually come out. There's pest inspection that you got to get done, and there's an appraisal. So there's certain, once you get your building inspection, we'll let you know what other inspections are required that the VA would want you to have, but no one from the actual VA, you have to schedule something for the VA to come out there and get it done. It'd just be the building inspector and the appraiser. Did anybody else have any questions?
Will we be able to get a copy of this PowerPoint?
Yeah, I can send it to you in a PDF.
Okay, thanks.
No problem.
This is Danita Gibson. I would like to have a copy of the PDF as well.
Okay, if you guys could, in the chat, put your email addresses in there, then we'll make sure we have them correctly. And I'll give you guys a PDF of this for you guys to buy. And the best way to reach me, I'll just put this also in the chat, is my website. It's got all my information on there. There's also where you are able to complete the application if you wanted to. Hold on, I need to do this. There we go. Did everyone see the website in the chat?
No, actually, I can't see anything in the chat. I had to dial in.
Oh, okay. Do you have something to write with? I can give it to you.
Okay, I'm going to my browser now. Give me just a second.
Okay.
I'm ready.
I do see it in the chat though. Sorry.
You do not see it in the chat?
It is in the chat, yes.
Okay.
I'm ready whenever you are.
Okay, it's www.KrisMills.net. And if you're on an iPhone or anything like that, and you're on Safari, you're gonna have to use Google.
Okay.
For some reason, Safari doesn't like, I don't know, it's always silly acting. But on there, it's got all my contact information. You click on there on the apply now button. That would be the first step that I would suggest you guys do, is to complete the application so I can assess credit wise where you're at, and then partner you with Yvette and Carol at Prosperity Connection to help you do the budgeting, because those two things go hand in hand. So whether you got a 7 credit score or a 700 credit score, that's the starting process to do the application, and then let us help you get assistance with the budgeting, because on our portfolio loan, we actually need to see an actual copy of the budget along with the 3 bank statements coming from the nonprofit.
I have a question. My name is Melinda. I'm the veteran, and I believe that I don't have to pay the PMI insurance or something with the VA loan.
That is absolutely correct.
Okay, and how does that work?
So basically, you're getting so let's say if you want to buy something for 100,000 with the VA loan, you can get that full 100,000. The thing that we would have to solve for you is the closing costs and the escrows of about 4.5% or the 4,500, and that's where the different down payment assistance and closing cost assistance, along with the seller, those three ways we could try to make up that $4,500 for you.
Okay. And with the earnest money, because I'm 100% service connected, I think the VA said they'll waive that.
That's the funding fee you're talking about.
Yeah, the funding
So
fee. Yeah, okay.
VA and FHA have a funding fee. So if you're considered more than 10% disabled, we'll have to get that on your certificate of eligibility, and then the funding fee will be waived. But those are usually financed. So give you an example, the funding fee I think is like 2.125. So they would finance basically $2,100 into the loan. So your loan will be $102,150. But
Okay.
if you don't,
3% or something.
yeah, I think they did increase it. That's right. It populates automatically in our system, along with the FHA one.
So that's separate from the earnest money, the funding fee.
That is correct. So earnest, so that's why I was saying those two buckets. So earnest money goes into that pool of that money that you need to have at least $1,000 to $1,500 of your own money.
Okay.
So, because what's going to happen is, it's just like putting a down payment on a car lot. You're going to give that money along with proof that you can get finance to that seller so he can take his home off the market.
Okay.
And then at closing, I suggest you do everything in the transaction either with a debit card or check. No credit cards, no cash. That way we can track everything out of your account and give you credit for it. At the time of closing, that $500 that you gave will be credited off. You know, it'll take your loan, you know, it'll take $500 off of everything that you need.
Okay, great. Thank you.
No problem. Okay, Ashley, I got your email. You guys have any other questions?
No, I don't.
All right. Well, if that is it. I thank you guys for showing up. We will do another one of these next month. So, if you know anybody, just give them the same website you went to so they can register. And I appreciate you guys' time.
Thank you.
Thank you.
All right,
Thank
you guys
you.
have a good evening.
You too.
You too.
Thank you.
You too.